Welcome to Tesla Daily News Podcast. It's Monday, March 9th, 2026. Today we're covering the biggest Tesla headlines that actually move the stock, new pricing pressure in Europe, a major competitive leap from BYD in fast charging, a key U.S. regulatory fight that touches Tesla's stance on emissions policy, fresh analyst targets, and why the AI hardware supply chain could become the next hidden constraint on Tesla's autonomy and robotics roadmap. Story 1. Tesla is pushing a cheaper Model 3 in Europe, and it's a demand lever with margin consequences. Here's the hook. Tesla's trying to relight demand with a sub €40,000 Model 3. Context. Europe has been a tougher battleground lately, more competitors, more price-sensitive buyers, and a lot of consumers comparing charging speeds and features across brands. Details. A German test drive report highlights a Model 3 standard at €36,990, with a stated test cycle range of 534 kilometers. It notes improved suspension tuning versus earlier versions, a return of the turn signal stock, and charging performance up to 175 kilowatts on fast charging, with a 10 to 80% session taking roughly 30 minutes under ideal conditions. The piece also points out that other manufacturers can charge faster. Impact. For investors, this is classic Tesla. Use pricing and product updates to defend volume. The upside is potential delivery stabilization in a key region. The trade-off is that, unless costs come down at the same time, pricing actions can keep gross margins under pressure, and that's what the market tends to punish or reward quarter by quarter. Takeaway. Watch whether this lower entry price shows up as improved registration trends in major EU markets, and watch gross margin commentary next earnings, because price-led demand is helpful only if Tesla keeps cost discipline. Story 2. BYD's 5-minute charging claim raises the competitive bar, but the infrastructure caveat matters. Hook. BYD is pitching something that sounds like a gasoline stop, 5 minutes of charging for about 400 kilometers of range. Context. The biggest friction point for mass EV adoption is still charging time, charging availability, and real-world reliability. Details. Multiple reports describe BYD's new fast charging platform with up to 1,000 kilowatts of power and up to 1,000 amps of current. One important nuance from TechCrunch Mobility, BYD's claim hinges on a specific compatible charger. Impact. From a Tesla perspective, fast charging is a key differentiator, not just peak speed, but network scale and uptime. If BYD can pair genuinely ultra-fast charging with a large, reliable charging rollout, it could shift consumer expectations and push Tesla to accelerate its own charging roadmap. If it remains a lab or limited network achievement, the stock impact is more sentiment than fundamentals. Takeaway. Investors should track two things: real-world charging curves and deployment. A breakthrough only matters if customers can actually use it at scale. Story 3. Germany's highway charging network is headed toward more competition, and that can reshape pricing power at premium locations. Hook. A court decision in Germany could finally speed up highway fast charger build-out and open it to more players. Context. Charging is both a customer acquisition tool and a strategic moat. In Europe, Tesla's supercharger advantage has narrowed as rivals expand, but premium highway locations still matter. Details. Germany's higher regional court in Düsseldorf ruled the approach by Autobahn GmbH and Tank and Rast to expand fast charging without a regular public tender was unlawful. Tank and Rast had planned to expand from roughly 350 fast chargers to about 2,300 additional units across its motorway service areas. The decision supports a new competitive tender process. Tesla had initially been involved in the dispute but later exited. Impact. More competition at rest stops can mean better service and potentially lower prices for drivers, which is good for EV adoption. For Tesla investors, it's a mixed bag. Faster public build-out can reduce Tesla's network differentiation, but it also grows the overall EV market, which can support vehicle demand. Takeaway. If Tesla continues opening superchargers to other brands, it can still monetize network usage, but pricing power at the best locations may be less assured as competition increases. Story 4. Tesla opposes a Trump EPA move targeting start-stop credits, and it signals Tesla's posture on emissions policy. Hook. Tesla is reportedly pushing back on removing start-stop incentives in the U.S. Context. Start-stop systems help reduce fuel consumption for internal combustion vehicles, and they've been supported through emissions credit structures. The Trump administration wants to remove the incentives tied to always-on start-stop. Details. A Czech report says the EPA plans to remove these emissions credits and notes that Tesla representatives disagree with the change. It also cites studies showing start-stop can reduce fuel use by roughly 7 to 26%, depending on driving style. Impact. This is not about Tesla installing start-stop, it's about the overall emissions and compliance ecosystem. Tesla historically benefits when regulations push the market toward lower emissions because it sells pure EVs. Policy signals that weaken fuel-saving incentives can be read as a broader easing of emissions pressure, which could slow the pace of EV adoption at the margin. Takeaway: investors should read this as a broader regulatory temperature check. If the U.S. environment becomes less supportive for emissions reductions, Tesla may need even stronger product and cost advantages to sustain growth. Story 5. Analyst targets are still broadly constructive, but the implied upside is modest from current levels. Hook. The street is not in full bearish mode, but it's not wildly bullish either. Context: when Tesla is trading near consensus targets, catalysts matter more than narratives. Details: FinanceN.net reports 3 analysts covered Tesla in February 2026, 1 buy and 2 holds. Average target price was about $406.67 versus a then-current price around $402.51. Barclays had a $360 target, while RBC listed $500. Impact: for the stock, this kind of setup often means the next big move needs a real fundamental surprise, deliveries, margins, or a clear autonomy monetization step. Without that, the stock can chop around based on macro and sentiment. Takeaway: watch for near-term catalysts that can move estimates, not just price targets. Deliveries and margins still do the heavy lifting. Story 6. The AI memory chip shortage could become a bottleneck for Tesla's autonomy, Dojo alternatives, and Optimus ambitions. Hook. A historic memory crunch is pushing costs up across tech, and Tesla is explicitly talking about the impact. Context: Tesla isn't only a car company. Its valuation embeds autonomy and robotics. That means compute matters, and compute depends on memory. Details: Bloomberg reports an AI-driven shortage in memory, especially high-bandwidth memory used in AI systems. It cites big tech capex on track for roughly $650 billion in 2026. The report notes leaders at companies including Tesla discussing profitability impacts and timelines, and says Elon Musk raised the idea of producing Tesla's own memory chips on an earnings call in late January. Impact: if memory remains scarce and expensive, it can raise Tesla's costs for training and inference infrastructure, slow iteration cycles, or force trade-offs between autonomy, robotics, and other capex priorities. That matters to long-duration valuation arguments, and it can feed the broader market's concern about AI capex returns. Takeaway: investors should treat AI hardware availability like a supply chain risk, not just an abstract tech issue. If Tesla can secure supply or find cost-effective alternatives, it's a competitive advantage. Quick market and positioning note: Tesla is still getting cited as part of the Magnificent Seven drawdown. Several market notes show Tesla down around 11% year-to-date in one snapshot, with broader Magnificent Seven weakness tied to capex and AI bubble fears. This matters because Tesla trades partly as a macro-sensitive, growth and tech proxy, so even good Tesla-specific news can get overwhelmed by risk-off tape. Before we wrap, one more sentiment data point from retail flows. The Street piece notes that Cathie Wood's ARK Innovation ETF still lists Tesla as its largest holding at about 10.36%, even as the fund has seen volatility and mixed long-term performance. Whether you agree with ARK or not, it's a reminder that Tesla remains a top high-conviction name for certain growth investors, and that can amplify swings on both good and bad headlines. That's it for today. Recap: Tesla is leaning on more accessible pricing in Europe. BYD is raising the charging speed narrative with a big asterisk around infrastructure. Germany is opening highway charging to more competition. U.S. emissions policy looks like another potential headwind. Analysts are mostly in a hold-to-buy posture with limited near-term upside implied, and AI memory shortages could quietly pressure Tesla's autonomy and robotics timelines. For tomorrow, watch for any new delivery or pricing data points, updates on fast charging network buildouts, and any fresh commentary on AI compute costs and availability. If you found this helpful, subscribe to Tesla Daily News Podcast and follow for your daily, investor-focused Tesla Roundup.